Have you ever wondered why the markets seem to be getting more and more volatile? Or how about the fact that nearly every high growth stock today bottomed and peaked within the exact same 10-minute window of each other? For example, on the one-day chart, we can see that Palantir stock bottomed between the 11:25 a.m. and 11:40 a.m. time period. CleanSpark bottomed between the 11:25 a.m. and 11:40 a.m. time period. Li-Cycle bottomed between the 11:25 a.m. and 11:40 a.m. window. Enphase Energy stock today bottomed between the 11:25 a.m. and 11:40 a.m. time period. Tesla stock bottomed between the 11:25 a.m. and the 11:40 a.m. time period. On the other hand, Palantir peaked between the 12:50 and 1 p.m. time period. CleanSpark peaked between the 12:50 and 1 p.m. time period. Li-Cycle peaked between the 12:50 and the 1 p.m. time period. Tattooed Chef peaked between the 12:50 and the 1 p.m. time period. Enphase Energy peaked between the 12:50 and the 1 p.m. time period. Tesla peaked between the 12:50 and 1 p.m. time period. Or maybe another question you've asked is, who in the heck is selling these stocks at these valuations? All of these stocks are tremendously undervalued according to history. But the selling pressure continues. Well, when we look at three different major indexes that track the overall stock market, we can see that the dark pool short volume ratio today was over 60% for the Russell 2000 small caps and mid cap companies. For the NASDAQ, again, over 60%. And the S&P 500 short interest was over 60%. And this is something that's been consistently happening since the end of 2021, basically. If we scroll down, we can see that dating back to the beginning of this year, 2022, the short volume on every single trading day this year has either met or exceeded the 50% threshold. This means that 50 to 60% plus of shares being sold on the markets on any given day is due to short selling. But let me tell you something. This is not coincidence. So, in this video, I'm going to be getting pretty technical about this and why algorithmic trading is destroying the stock market right now. But first, I just want to say, if you guys are new here or returning and not yet subscribed, I would greatly appreciate you hitting that subscribe button down below. And also, this is a pretty important topic. So let me know your thoughts in the comment section down below on algorithmic trading, and a lucky winner will receive $50 from me sometime over the next month. So make sure you subscribe and leave your thoughts on this topic down in the comment section below. It could be absolutely free money for you. But anyways, let's get into the nitty-gritty about this topic. As you can probably tell from the title of this video, the reason the stock market is acting so weird is because of algorithmic trading. If you guys weren't aware, upwards of 73% of daily trading volume on any given day is attributable to algorithms and computers. More than likely, anytime you buy or sell a stock in the stock market, you're actually trading hands with a computer or an algorithm, not another human being. If you guys are unfamiliar with what algorithmic trading is, I'll give you a brief explanation now. Basically, algorithmic trading is used primarily by institutions and big money managers in the stock market, and it's where computers identify market patterns and utilize pre-programmed instructions to execute millions of trades in milliseconds. And the funny fact about all of this is algorithms and computers, they really don't care about company fundamentals. They care about what is most profitable to their algorithm or the way they are instructed to execute trades. So, the fact that valuations on stocks right now are at historical lows for some companies, that doesn't matter to the algorithms. The fact that in January and February of last year in 2021, valuations were way out of whack to the upside, that didn't matter to algorithms. But markets are meant to be efficient and brilliant at finding the correct values for different things. But the stock market right now is anything but that. Think over the last 3 years. What has happened that has been normal and efficient about the stock market? All that's happened is extreme valuations on the upside and extreme valuations on the downside. And that is all driven by algorithmic trading. It's also a fact that company fundamentals being so far separated from company valuations constantly on the upside and the downside is the nature of the stock market more so than ever before right now, even rivaling the tech bubble. So now I ask you this, is it okay for this to be going on? Is it okay for a market to be inefficient and fundamentals to be so far separated from valuations? My answer for that is no. This is something that truly needs to be fixed because all this does is it benefits the people behind these algorithms, which are big money managers, and it hurts the retail investor. How many retail investors are still holding the bag from January and February of 2021? Better yet, how many retail investors are more red than they ever have been before right now due to this algorithmic selling in the stock market that's taking place? A lot. And again, a market is meant to be efficient. What is efficient about this? So now you have to ponder, what can we do to fix this? Because this isn't right. This isn't okay for big money managers and algorithms and computers to be profiting millions and millions of dollars per trade at the expense of the retail investor. This hurts the vast majority of people. And anything that hurts the vast majority of people, I think people should be against. So what can we do to fix this? Well, one idea that's been presented is a trading tax on a per share basis. I actually really like this idea because the algorithms and the computers that trade millions of shares of stock per second would be hurt the most from this. And you know who would benefit the most? It would be you and me, the retail investor. Because if you start taxing these millions of shares that are trading hands or computers and algorithms, all of a sudden that sort of behavior will drop. Because the profitability of that trading philosophy drops. A per share trading tax wouldn't hurt you or me because for the most part, we're buying and selling hundreds of shares or thousands of shares at a time, not millions and millions of shares at a time. So if this idea ever gets some traction, I will gladly put my name behind it. And better yet, the government gets to rake in even more cash. And we all know that the government needs cash and needs income right now. But now you may be wondering, okay, when is this going to end, or is it going to end? You just got done discussing how company fundamentals don't matter to algorithms and computers, and they don't. But this will end, as it always has. Last year in January and February, did stocks keep going up? No, they didn't keep going up. They came crashing back down to the point we're at right now. So this will end. In the fact that the broad stock market indexes have 60% short volume on any given trading day tells me that the recovery from this crash is going to be quick. Things are going to recover just as fast as they fell down, because as soon as bulls take control of this, that is a lot of short covering that needs to take place. Basically, what happens when stocks start going up is all of these short sellers, whether that's humans or computers or algorithms, they're forced to buy shares on the open market to cover their position, to cover their borrowed shares that they sold into the markets to crash the price even further and bet against those stocks rising. And, 60% short volume is a lot for an individual stock. But for a market index and a market benchmark, 60% short volume on any given trading day is incredible. So I guess what I'm saying is, when this thing flips, it's going to flip very, very fast because there aren't any natural sellers left in this market. I began this video talking about that. Who in the world in their right mind is selling these stocks at these valuations? Nobody is. This is all algorithms putting selling pressure on stocks as retail investors are holding the bag. So what can you do to profit off of this? I just got done discussing how I feel the recovery is going to be just as quick as the fall was. Well, one key ingredient in the stock market that so many people mess up on and they miss is patience. I know so many of you watching this video right now have been buying the dip and buying the dip and buying the dip with no end in sight. And it feels like you're wasting your time and you're wasting your money. But let me tell you, patience is key in the stock market. And if you have patience, you're going to do very, very well in the stock market. So that's key ingredient number one. Even though we know that this reversal is going to happen, we don't know when it's going to happen, but patience fixes that issue. The second thing you can do is, if you haven't already been buying the dip, buy the dang dip in your favorite stocks or your favorite companies and sit on those stocks and hold them patiently. As for catalysts that could cause this reversal back to the upside, it could be something like inflation numbers being lower than expectations. Because the way algorithms are created and developed and coded, basically, they're either going to put extreme short selling pressure on the market based on inflation numbers and expectations, or they're going to take some selling pressure off and start buying if the actual results are less than the expectations in regards to inflation. So that's one thing we can look for. Other than that, I'll let you guys be creative. There are several different catalysts out there that could cause this reversal, from silly small things to big things like inflation numbers. But we know that this reversal is going to happen, so I'm going to leave you with this. Be patient and buy the dip in your favorite stocks and your favorite companies, and you're going to do very, very well. Again, I'm not a financial advisor. I'm a 20-year-old kid speaking through a microphone to you guys watching this video on YouTube. Please don't take any of what I said as financial advice. I'm simply sharing my thoughts and opinions. I could very well be wrong about this entire thing. But again, if you guys enjoyed, please leave a like down below and leave your comments on your thoughts on this topic. Again, some lucky winner will get $50 sent to them for sharing their thoughts. And if you guys are new here or returning and not yet subscribed, I'd greatly appreciate you hitting that subscribe button down below. And with that, I hope you have a great rest of your day. Peace out.